Imagine you're sitting at your trading desk right now.
Right.
Your monitors are glowing, the markets have just opened for the day, and you're staring at a standard candlestick chart.
Just the standard setup.
Exactly. You're looking at, say, the S&P 500 or maybe Bitcoin or, a major Forex pair, and you see the price action unfolding. You've got higher highs, lower lows, wicks testing certain levels and rejecting.
Yeah, the usual chaos.
Right. But if we're being completely honest here, looking at pure price action in today's hyper-efficient algorithmic market,
Yeah.
it often feels like trying to navigate a dense forest at midnight without a flashlight.
Oh, absolutely. It's blinding.
You can see the immediate obstacle right in front of you, like the current candle, but you have no idea where the actual structural foundations of the landscape are.
None at all.
So without any other context, trying to predict whether that price is going to suddenly surge higher to break resistance or just violently crash down through support, it feels like a nearly impossible guessing game.
Yeah, and the reason it feels like a guessing game is because you're only looking at one dimension of a multi-dimensional battlefield.
Right.
You're looking at price, and maybe you're looking at time along the bottom, but you are entirely blind to the actual distribution of capital.
The actual money.
Exactly. When you stare at naked candlesticks, you're essentially looking at the aftermath of a conflict without knowing where the opposing armies have actually built their fortifications.
And that guessing game, that exact feeling of being blind, is exactly what we're going to eliminate today.
Yes.
The mission of today's deep dive is to unlock a tool that acts as structural X-ray vision for the markets.
X-ray vision is a great way to put it.
It's called volume profile. And the moment you overlay this onto that exact same confusing candlestick chart,
Yeah.
the random chaotic price movements suddenly snap into focus.
They really do. It's night and day.
The seemingly invisible barriers driving the market just reveal themselves. And we're pulling from an incredible stack of sources today. We've got detailed transcripts from top trading analysts like Trading Notes, Trader Dale, and Mind Math Money.
All fantastic sources.
Yeah, alongside some really deep technical strategy guides from the charting platform TrendSpider. So we're going to extract the ultimate shortcuts to understanding exactly where the smart money is transacting.
And it really is a profound shift in perspective because, most retail traders obsess over time-based volume.
Right, the little bars at the bottom.
Yeah, they look at the bottom of their screen at those vertical bars to see how much was traded during a specific 5-minute candle or a daily session. But time-based volume only tells you when an influx of participation happened.
Just the timing.
Right. Volume profile completely flips the script. It calculates and displays volume by price.
By price, okay.
And if we zoom out to understand the actual mechanics of the market, this is critical because large institutions, market makers, hedge funds, they can easily manipulate price.
Oh, for sure. Running stops and all that.
Exactly. They can run stops, they can engineer fake breakouts to trap retail liquidity, but they absolutely cannot manipulate volume.
Because the money has to go somewhere.
Right. When an entity needs to move hundreds of millions of dollars into an asset, it leaves an undeniable footprint. Volume profile is basically the proprietary lens that illuminates those exact footprints.
But I want to push back on that slightly, though.
Sure.
If these institutions know that their massive orders leave footprints, aren't they using complex algorithms like time-weighted average price or TWAP to slice those orders up into tiny invisible pieces over weeks?
Oh, they absolutely are.
So how does a visual indicator catch that if they're actively trying to hide?
Well, that's the beauty of mapping volume by price rather than time. You're completely right that an institution will slice a massive order into, say, $1,000 chunks and execute them over 3 weeks to avoid spiking the price.
Right, to stay under the radar.
Yeah. And if you're looking at a standard daily volume bar at the bottom of your chart, those chopped up orders blend in perfectly with normal daily retail noise. You just won't see it.
It just looks like a normal Tuesday.
Exactly. But because that institution requires a specific average entry price to meet their risk parameters, they're executing all those thousands of tiny orders within a very tight specific price band.
Ah, I see.
So over 3 weeks, the volume profile aggregates all that stealthy, chopped-up activity at that specific price level, and suddenly a massive horizontal shelf appears on your chart.
Wow.
They can hide their activity across time, but they cannot hide it across price.
That makes perfect sense. They literally have to park the capital somewhere. So our goal today is to walk you through exactly how to track this capital.
Step by step.
We're going to dissect what this tool looks like, how to set it up properly, We'll identify high-volume accumulation zones, pinpoint exact price levels for entries, and build a framework for risk management.
Which is huge.
Specifically, where to place your stop loss so you don't get shaken out by market noise. And crucially, we're going to tackle the psychological discipline required to trade these setups without succumbing to the fear of missing out.
FOMO is the account killer.
Because knowing where the smart money is positioned is completely useless if you lack the patience to let the trade come to you.
Yeah, the psychology is often the point of failure. I mean, you can have the best institutional map in the world, but if you panic and force a trade in the middle of a low probability zone just because the candle looks aggressively green.
Just because it's moving fast.
Exactly. The map won't save you if you do that.
So let's start by looking at this map. Let's break down the anatomy of the volume profile.
Okay.
If a listener pulls this up on their charting software right now, it's going to look completely alien compared to traditional indicators like an RSI or moving average.
Yeah, it's very different visually.
So what are we actually looking at, and what's the underlying market logic behind these new visual elements?
Well, unlike traditional volume, which, as we said, prints vertically along the x-axis of time, volume profile prints horizontally along the y-axis of price.
Okay, so it's on the side of the screen.
Right. It essentially creates a histogram that sticks out from the side of your chart, pointing inward toward the candlesticks.
Got it.
It measures the total volume traded every single price tick over a specified period. So when you look at it, you're going to see a series of horizontal bars of varying lengths.
Like a sideways bar chart.
Yeah, exactly. And to decode this, there are a few core concepts from our sources that you really need to internalize, starting with the point of control, or the POC.
And the POC is visually the most obvious thing on the indicator, right? It's usually the thickest, longest horizontal line extending out from the side of the chart, and it's often highlighted in a different color.
Yes, exactly. The point of control is the specific price level that saw the maximum amount of trading volume during the entire period you're analyzing.
The absolute maximum.
Right. It is the absolute peak of market participation.
Yeah.
More contracts, more shares, or more coins changed hands at that exact price than anywhere else.
Okay.
Mathematically, it basically represents the ultimate agreement on fair value between buyers and sellers for that given time frame.
Fair value.
And because such a massive amount of capital is anchored to that specific price, it acts as an incredibly powerful gravitational pull on the market.
But wait, if it's the ultimate agreement between buyers and sellers, doesn't that just mean the market is happy there and will just go sideways?
You'd think so, yeah.
Why does it act as a magnet later on after the price has already moved away from it?
Well, that goes to the heart of order flow mechanics. Think about who is doing all that transacting.
The big guys.
Right. It's not a million retail traders perfectly coordinating their clicks. It's massive institutional players. Let's say a fund accumulates a massive long position at that POC, and eventually the buying pressure exhausts the sellers and the price rallies heavily away from it.
So it shoots up.
Yeah. That institution is now deeply in profit. But, markets ebb and flow. So weeks later, the price begins to retrace back down toward that original POC.
Okay, coming back to the scene of the crime.
Exactly. And that institution still holds that massive position. Their average entry price is right at that POC line.
Oh, I see where this is going.
Yeah, if the price drops below it, their massive profitable trade suddenly goes underwater. The risk management algorithms will trigger.
They start losing money.
Right. So what do? Before the price can break their average entry, they step into the market and buy aggressively to defend their territory.
Wow.
They have a vested multi-million-dollar interest in not letting the price cross that line. That is why it acts as a magnet as it gets closer and then as a trampoline when it hits.
Because they're defending their average fill.
Precisely.
Okay, so that's the point of control, the absolute peak. But the POC doesn't just float in isolation.
No, it doesn't.
It's usually surrounded by a broader, sort of shaded region on the histogram. The sources from TrendSpider and Trading Notes refer to this as the value area.
Yeah, the value area. And this is rooted in standard distribution statistics.
Yeah.
It's the range of prices that contains exactly 70% of the total trading volume for the profiled period.
70%.
Right. Think of a bell curve. The value area represents one standard deviation from the mean, so it's the core area where the vast majority of business was conducted.
Okay.
It's bounded by two distinct levels. The value area high, or VAH, at the top, and the value area low, VAL, at the bottom.
So if the price is trading inside that 70% zone, the market considers the asset to be fairly priced. It's in the institutional comfort zone.
That's a great term for it.
But what actually happens inside that comfort zone? Because the histogram isn't just one smooth, perfect curve. It's jagged.
Very jagged.
You have these clusters of really long horizontal bars, which the sources call high-volume nodes or HVNs. They visually look like thick shelves protruding into the chart.
Those volume shelves are incredibly important. The POC is just the single largest node, right? But a chart can have multiple high-volume nodes.
Okay.
These represent secondary areas of massive consolidation and institutional interest. They're thick, dense zones of liquidity. Whenever the price approaches an HVN, it's like walking into waist-deep mud.
Mud? That's a good visual.
Yeah, the price action usually slows down, it consolidates, and chops sideways because it takes a massive amount of buying or selling pressure to chew through all the resting limit orders that are naturally clustered in these fair value zones.
So they act as thick barriers of support or resistance.
Exactly.
Okay, I understand the mud analogy, how volume means high liquidity, which means it's hard for the price to just blast through it.
Right.
But this leads to what I think is the most counterintuitive part of the whole concept.
Yeah.
Mixed in between these thick shelves are gaps.
Yeah.
Short, stubby bars where the histogram barely registers any volume at all. The sources call these low-volume nodes, or LVN.
The LVNs, yeah.
And my instinct, and probably the instinct of anyone just looking at a chart, is to ignore the areas where nothing happened. I mean, if there's no volume, there's no interest, so who cares?
It makes sense to think that.
Why do the sources emphasize these empty zones so heavily?
It is entirely counterintuitive, but the absence of historical volume is arguably the most explosive element on the chart.
Really?
Explosive.
Absolutely.
You have to understand order book mechanics to grasp why. A low volume node represents a price zone where buyers and sellers historically could not agree on fair value.
So they just skipped it.
Basically, yeah. The price didn't spend time there, it was rejected quickly. Because the market sped through that area in the past, no one built massive positions there.
Oh, I see.
Therefore, there are very few resting limit orders, bids, or asks sitting in that zone today.
So the order book is effectively thin or hollow at those specific prices.
Exactly. It's a liquidity vacuum. So imagine the price is slowly churning through a thick, high-volume node, chewing through all those resting orders.
Trudging through the mud.
Trudging through the mud. And then finally, it breaks out of the mud and enters a low-volume node. Because there are no resting orders to absorb the buying or selling pressure, even a relatively small amount of market orders will cause the price to gap violently.
Wow.
It slips through the LVN like a hot knife through butter until it slams into the next high-volume node where liquidity is thick again.
It's an air pocket.
Yes, an air pocket.
So if you're a trader, you really care about LVNs for two reasons. First, you never want to expect the price to consolidate or bounce in an LVN because there's just nothing there to stop it.
Right. Don't look for support in a vacuum.
And second, if you can identify when the price is about to enter an LVN, you can capitalize on incredibly fast, violent momentum trades because you know the structural friction is completely gone.
Precisely. You use the thick shelves for your entries and your support, and you ride the wave through the thin vacuums to capture rapid profit.
That is so cool. Now, before we move into the actual trading strategies, I want to quickly demystify the platform setup because the sources provide some very practical, actionable advice here to avoid getting bogged down in, expensive software or visual clutter.
Yeah, a lot of traders assume they need a Bloomberg terminal or a $1,000 software suite to access order flow data like this.
Right. They think it's out of reach. But the sources explicitly state that standard charting platforms like TradingView offer incredibly robust versions of this for free or on basic tiers.
Very true.
They highlight two main tools. The first is the fixed range volume profile.
Love the fixed range.
Yeah, it's basically a drag and drop tool. You click on a specific point on your chart, say the beginning of a month-long sideways consolidation, and you drag the tool to the end of it.
Just draw a box over it.
Right. And the platform instantly calculates the volume distribution just for that highlighted box. It lets you isolate specific market events.
It's fantastic for analyzing a specific piece of chop.
Yeah.
And then there's the anchored volume profile, which is even more dynamic.
How does that one work?
You anchor it to a major macroeconomic event, maybe an earnings report, a Federal Reserve interest rate decision, or just a massive market bottom.
Okay, a specific starting point.
Yeah. The profile then continuously calculates the volume distribution from that exact timestamp forward, updating in real time as new candles print.
Oh, that's powerful.
It is. It tells
Yeah.
you exactly how the market has valued the asset since that specific catalyst occurred.
And a quick tip on visual clutter. The sources recommend aggressively simplifying your color scheme.
Oh, yes. Please do this.
Because when you first turn volume profile on, it might try to color code the volume by buying in green and selling in red.
Which is a nightmare to look at.
It really is. When you have red and green volume bars overlapping with your red and green candlesticks, your brain just has to process way too much conflicting information.
It's sensory overload.
So the recommendation is to make the entire profile uniform. Make the up and down volume both solid blue, and maybe shade the value area a slightly lighter blue.
Keep it clean.
But, and this is the critical trick, force the platform to paint the point of control in a bold, vibrant red or yellow line.
Make it pop.
Exactly. When you glance at the chart, you don't want to be analyzing shades of green. You want that magnetic institutional POC to be the absolute first thing your eye snaps to.
Visual processing speed really matters. In a fast-moving market, you need to identify the structural walls instantly. Eliminating the noise is the first step to executing with discipline.
Okay, so we have a clear picture of the map now. We understand the thick, high-volume mud, the low-volume air pockets, and the magnetic red line of the POC.
The landscape is set.
But knowing the map and fighting the war are two completely different things. Why does the market respect these lines so religiously? We touched on it briefly, but we really need to dig deeper into the actual psychology of institutional warfare.
We do. We need to explore the concept of the line in the sand.
Okay, the line in the sand.
See, retail traders often project their own trading realities onto institutions. A retail trader might risk, 2% of a $10,000 account. So, like, $200.
Exactly.
Yeah.
If they get stopped out, they lose $200. It's annoying, maybe ruins their morning, but they move on.
Sure.
An institutional portfolio manager is operating under a completely different paradigm. They might be managing a $3 billion fund.
It's a lot of zeros.
Right. And if they initiate a $500 million position in an asset, they cannot simply use a tight mathematical stop loss. The liquidity required to exit a position of that size simply does not exist without crashing the market and causing massive slippage against their own orders.
So they're effectively trapped in their own size.
That's exactly it. They're committed. So when they spend weeks building that massive position, which prints as a giant high-volume node on our charts, that average entry price becomes critical to their actual survival.
The line in the sand.
Yes, let's say it's a long position. The market rallies, they show a huge paper profit to their investors, everyone's happy.
Yeah.
But then macroeconomic conditions shift.
Something bad happens. A bad jobs report comes out, or there's geopolitical tension, and retail panic ensues. The price starts falling aggressively, heading straight back toward the institution's massive high-volume node.
And from a retail perspective, looking at just the candles, the trend looks broken. It looks like a total bloodbath. Retail traders are probably shorting the market, panicking, expecting it to go to zero.
And that is exactly where retail gets slaughtered.
Why?
Because as that price falls into the high-volume node and approaches the point of control, the institution's algorithms wake up. If the price falls below their POC, their $500 million position goes negative.
Oh, yeah.
They will face margin calls from prime brokers. Their quarterly performance metrics will tank.
Oh.
So they have the capital reserves and the absolute necessity to defend that level.
They have to fight back.
Exactly. They start absorbing all the retail panic selling. They deploy massive buy limit orders. They construct a literal wall of money.
A wall of money.
Retail traders are throwing market sell orders at the wall. And the institution is just eating them, accumulating an even larger position at their preferred average price.
And eventually, the retail selling pressure just dries up because retail capital is finite.
Very finite.
The institution holds the line, and then they aggressively push the price back up, squeezing all the retail traders who just went short at the bottom.
It is a brutal mechanical transfer of wealth from impatient retail traders to structural institutional players.
Just brutal.
But as a volume profile trader, you aren't the one panicking. You are watching the price fall toward the POC, and you are calmly waiting to buy right alongside the institution.
But this introduces a massive psychological hurdle, and the sources emphasize this repeatedly. To successfully piggyback on institutional defense, you must master patience, and you must understand the concept of the pullback.
Yes, the pullback.
You cannot trade the initial breakout.
The initial breakout is the siren song for amateur traders.
It really is. It looks so tempting.
Oh, it does. Imagine you're watching a chart, and the price has been chopping sideways inside a high-volume node for days. It's boring.
Just flat.
Suddenly, massive volume spikes and a huge green candlestick erupts out of the zone, breaking resistance. The emotional response is immediate. FOMO, fear of missing out.
Oh, yeah. It's leaving without me.
Exactly. The amateur trader thinks the move is happening right now, I have to get in. And they hit the buy button at the absolute top of the massive green candle.
Which is almost always right before the asset exhausts its immediate momentum and begins to retrace.
Almost always. Because the algorithms that initiated the breakout will often immediately stop buying just to see if the market will naturally follow.
Testing the waters.
Right. And when it doesn't, gravity takes over. The price retraces. The amateur trader who bought the top is now underwater, panicking, and they sell for a loss.
So what is the professional volume profile trader doing during that massive green breakout candle?
Sitting on their hands.
Just watching.
Just watching. They watch the price distance itself from the POC. They want to see clear, undeniable separation. They want proof that the market has actually accepted higher prices.
Okay.
And then they wait for the inevitable pullback. They might wait 3 hours or they might wait 3 weeks. They wait for the market to exhaust itself and slowly drift back down to retest the original high-volume node.
And there is a golden rule attached to this patience, specifically highlighted in Trader Dale's methodology. The first touch principle.
The first touch. Crucial.
You only ever trade the first time the price comes back to test the zone. If it bounces and then comes back a second or third time, you stay away.
You have to stay away.
Why is the first touch so sacred?
It comes back to the ammunition of the defenders. When the price pulls back to the institutional line in the sand for the very first time, the defending institution is fresh.
Their pockets are full.
Right. They haven't had to expend any capital defending it yet. Their resting limit orders are fully intact. The probability of the wall holding is at its absolute highest. But let's say it bounces, goes up a bit, and then selling pressure returns, forcing the price back down to the POC for a second test.
So the wall has already taken damage.
Exactly. The institution used up a significant chunk of their capital defending it the first time. They absorbed millions of dollars of selling pressure.
Right.
If it comes back again, their reserves are depleted. The resting liquidity is thinner. The structural integrity of the high-volume node is compromised.
It's cracking.
By the third or fourth test, the institution might simply decide it's too expensive to keep defending. They pull their bids and the floor completely collapses.
Wow.
The volume profile trader understands this degradation of liquidity, which is why they only ever risk capital on the pristine, high-probability first touch.
I want to address a critical friction point here, though.
Okay, let's hear it.
If we understand the institutional defense and we patiently wait for the first pullback to the POC,
Yeah.
there is a very specific, agonizing scenario that the trading note source brought up. It's the flaw of waiting for perfection.
The exact line problem. Yes.
Right. Let me describe this, because anyone who has tried to trade off technical levels has experienced this absolute torture.
It's the worst feeling.
You've done everything right. You identified a beautiful, thick volume shelf. You marked your bold red point of control line right in the middle.
Perfect setup.
You conquered your FOMO, you didn't buy the breakout, you watched the price separate, and now it is slowly, methodically pulling back. It's falling straight toward your red POC line.
Here it comes.
You place your buy limit order exactly on the POC, waiting for the institutional bounce. The price gets within 5 cents of your order, gets within 2 cents, and then
it stops.
it stops. It completely reverses, surges upward, and goes on a massive 20% run, leaving your unfilled order just sitting in the dust. You predicted the market perfectly, and you made exactly $0.
It is the most frustrating experience in trading, and honestly, it leads many traders to abandon the strategy entirely.
Because they feel cheated.
They do. But the failure isn't the indicator. The failure is a misunderstanding of how institutional scale actually operates.
How so?
Well, a retail trader thinks of support as a specific penny. The POC is at exactly $150, so I will buy at $150.
Right, but on the dot.
But remember, institutions don't trade on a single penny. They are deploying hundreds of millions of dollars. They operate in zones.
Zones. So the high volume node isn't just a mountain peak, it's like a massive plateau.
It is an entire defensive perimeter. Think of a military camp. The point of control is the general's command tent sitting dead in the center of the fortress.
Okay.
But the army has constructed massive walls around the entire perimeter of the camp. That outer wall is represented visually by the outer edge of the high volume node on your chart, the point where the volume histogram suddenly spikes outward from the low volume area.
So if we think about how an institution defends that zone, they aren't going to let the opposing selling pressure march all the way into the center of the camp, right up to the general's tent, before they start firing back.
Not at all.
They're going to engage the enemy at the outer wall.
Precisely. If their average entry is at $150, they might start aggressively buying at $152 just to ensure the price never even threatens their core position.
Wow, so they're front-running their own defense.
Exactly. Furthermore, algorithmic trading firms and other smart money players know the massive institution is sitting at $150.
Oh, they can see the map, too.
Right. So those smaller funds will front-run the big fund, placing their buy orders at $151 or $152, trying to catch the bounce early. This creates a massive cluster of liquidity at the very edge of the volume shelf.
So the refined strategy, like the massive breakthrough for the retail trader here, is to stop trying to be a perfectionist with the POC line.
Yes. Stop chasing the exact line.
You optimize your entry by shifting it to the edge of the zone.
Exactly. If you're looking to go long on a pullback, you identify the thick volume shelf and you place your entry order at the upper boundary of that shelf. The moment the price touches the roof of the fortress, you want to be in the trade. Conversely, if you're looking to short a market that is pulling back upward into resistance, you place your sell order at the lower boundary, the floor of the volume cluster overhead.
Now, I have to play devil's advocate here for a second.
Go for it.
By moving your entry to the edge of the zone rather than the center, you're effectively giving up profit wedging. You're buying higher or selling lower, which mathematically worsens your risk-to-reward ratio.
It does.
Is that trade-off actually worth it?
It is the most profitable trade-off you can make.
Really?
Yes. Your theoretical profit margin on a single trade might decrease by a fraction of a percent, but your fill rate, the percentage of times your order actually gets executed and you participate in the move, increases exponentially.
So you actually get into the game.
Exactly. Trading is about expected value over hundreds of executions. A strategy that offers a slightly smaller reward but gets you into the market 80% of the time will massively outperform a quote-unquote perfect strategy that only triggers 10% of the time while leaving you on the sidelines for the other 90%.
It's the difference between being a profitable trader and just an unpaid market analyst.
That is a perfect way to put it.
So now that we have the optimized entry at the perimeter of the zone, let's look at how the professionals actually deploy this in real markets. I want to dig heavily into the battle-tested strategies laid out by Trader Dale.
Oh, Dale's stuff is fantastic.
This source is fascinating because we aren't just looking at theoretical setups. Dale has a publicly documented track record spanning roughly 10 years, achieving a 66% to 71% win rate, trading these exact volume profile concepts across major forex pairs, indices, and commodities.
Yeah, and maintaining a win rate near 70% over a decade in highly liquid, efficient markets like Forex is practically unheard of for retail traders relying on traditional lagging indicators like RSI or MACD.
Right, it's crazy high.
It speaks to the absolute robustness of tracking structural volume rather than mathematical momentum.
He breaks down 3 distinct, highly actionable strategies. So let's walk through strategy 1 in deep detail, the volume accumulation strategy.
Okay, the accumulation strategy.
What is the fundamental setup here?
Well, the volume accumulation strategy is designed to catch the genesis of a brand new massive trend. It requires profound patience.
Because that word again, patience.
The setup begins by identifying a market that is doing absolutely nothing.
Nothing.
You are looking for a rotation, a sideways, boring, choppy market. The price is just ping-ponging between a tight support and resistance range for days or even weeks. Most retail traders ignore these charts because there is no action.
But the smart money is highly active in that chop, aren't they?
They are the ones creating the chop.
Oh.
This sideways period is when institutions are quietly executing their massive TWAP algorithms. They are slowly, methodically accumulating a massive position, absorbing every retail buy and sell order without letting the price break out of the range. They're loading the spring.
So as a trader, what is the exact mechanical action I take when I see this?
When you see this extended sideways chop, you deploy your fixed range volume profile. You draw the box exclusively over that sideways period. You want to look inside the rotation.
Okay, X-ray the chop.
Right. The profile will instantly reveal a massive, thick, high-volume node right in the middle of that chop. That is the exact price level where the institution built their core position. You identify the outer edge of that volume, shelf the boundary, And then you wait.
You wait for the breakout.
No, well, you wait for the breakout to happen, but you do not trade it.
Oh, right. FOMO control.
Exactly. Eventually, the institution finishes accumulating and they let the price rip. It violently breaks out of the sideways channel and starts a massive new trend.
And the amateur chases it.
The amateur chases the trend. You, utilizing the volume accumulation strategy, draw a horizontal line at the edge of the volume shelf left behind, and you wait for the market to exhaust itself.
Okay.
Eventually, weeks later, the price will pull back to retest that accumulation zone. When it touches that perimeter line for the first time, you execute your trade in the direction of the original breakout. You are betting that the institution will defend the massive position they spent weeks building.
Let's contextualize this with a real-world asset. The Mayan Math Money Source provided a phenomenal breakdown of this exact behavior in Bitcoin.
Crypto is a great example for this.
Yeah, and crypto is unique because there are no fundamental earnings reports.
Yeah.
It's purely driven by liquidity and volume.
It's the purest expression of order flow out there.
So the source detailed a scenario where Bitcoin went through a grueling multi-week consolidation phase. Let's say it was chopping endlessly around the $40,000 to $43,000 mark.
Just bouncing around.
Retail traders were getting chopped to pieces trying to trade the range. But when the anchored volume profile was applied to that period, it revealed a massive, undeniable point of control, dead set, at $41,500. It was a giant red line on the chart.
The institutional loading zone.
Exactly. Then the breakout happens. Bitcoin surges violently from $43,000 all the way up to $55,000 in a massive, impulsive green wave.
Oh man, that's when everyone gets excited.
Everyone is euphoric. They're calling for 100K. But then the momentum stalls and the inevitable correction begins. The price starts sliding back down. 50K, 48K, 45K.
The panic sets in.
The market sentiment completely flips to panic. But the volume profile trader isn't panicking. They have their buy limit order sitting patiently at the upper edge of that $41,500 volume shelf.
And notice what happens as the price falls through the mid-40s. Because the initial breakout was so fast and violent, there was very little volume transacted between $44,000 and $50,000.
It created a massive low-volume node.
The air pocket.
All right, so as Bitcoin corrects, it enters that LVN, and the selling accelerates terrifyingly fast because there's no historical liquidity to stop it. It plunges.
Just free fall.
But the moment the price hits the upper boundary of that $41,500 accumulation zone,
Yeah.
it is like hitting a concrete floor.
The
The source noted that the price didn't just bounce once. It hit the zone, spiked up, came back down a week later, hit it again, and spiked up again. It defended the level multiple times before eventually launching to new all-time highs. The algorithmic defense at that specific volume shelf was impenetrable.
That perfectly illustrates the power of combining the accumulation strategy with the understanding of LVN air pockets. It's a beautiful setup.
Okay, let's move to Trader Dale's strategy 2, the rejection strategy. How does this differ from the sideways accumulation we just talked about?
Well, the rejection strategy is much more aggressive and happens over a shorter time frame. Instead of looking for boring sideways chop, you are looking for a violent disagreement on the chart.
A disagreement.
Yeah, you're looking for a sharp V-shaped price action.
Give me the mechanics of a V-shape. Like, what does it look like in real time?
Okay, imagine the price of gold is plummeting. Massive red candles. Macro news is bad, everyone is selling. The price drops aggressively over a few hours.
A total dump.
Right. But suddenly it hits a specific price, let's say $2,000 an ounce, and it doesn't just stop, it violently reverses. The next few candles are massive green surges, erasing all the downward movement.
Just ripping back up.
Exactly. The chart prints a sharp V at the bottom.
So what does that V-shape actually tell us about the order flow?
It tells us that aggressive sellers were in total control, driving the price down, but at $2,000, they ran into an absolute wall of completely overwhelming buying pressure.
Just a brick wall.
Right. A massive entity, or maybe a group of entities, decided that $2,000 was severely underpriced, and they deployed enough capital to instantly absorb all the selling and reverse the momentum of the entire market.
So how do we trade it? I mean, we obviously can't catch the exact bottom of the V in real time.
Oh, you don't even try to. Once the V shape has formed and the price has moved higher, you take your anchored volume profile and anchor it specifically to the start of the downward drop, encompassing the V reversal.
Okay, measure the whole move down and back up.
Yes. The profile will calculate the volume, and it will show you a very specific, localized volume cluster right near the bottom of the V.
No.
That cluster is the exact footprint of where those massive buyers stepped in. You identify the upper edge of that cluster and you wait.
Waiting again?
Always waiting. When the price eventually drifts back down into the V-shape area weeks later, you place a long order at the top of that specific volume cluster. You're operating on the premise that those hyper-aggressive buyers who turned the market the first time are still sitting there, ready to defend their turf.
It's like catching the echo of a violent reversal. I love it.
It's a very powerful setup.
Now, strategy 3 is highlighted as Trader Dale's absolute favorite, and it relies on a concept called confluence. It's the trend strategy.
Confluence is the holy grail of technical analysis.
Explain that for the audience.
It's when two completely different methodologies point to the exact same conclusion. When you find confluence, your probability of a successful trade skyrockets. And the trend strategy is built entirely around this.
Let's break down the setup.
You start by identifying a market that is already in a clear, established trend. Let's use an uptrend on a major Forex pair, like the Euro-US dollar, Euro-USD.
Okay, the euro is climbing.
The chart is making higher highs and higher lows.
No.
You anchor your volume profile to the very beginning of the entire macro uptrend.
So we're profiling months of data here.
Yes, you're looking at the volume distribution of the entire trend. Now, in any healthy trend, the price doesn't just go up in a straight line. It moves up, pauses to consolidate, moves up again, pauses again.
Like stair steps.
Exactly. When you look at the macro volume profile, those pauses print as significant volume clusters mid-trend. These are structural pit stops.
Let's stop.
It's where institutions pause to accumulate more inventory before pushing the price higher.
So we find a thick volume cluster mid-trend. But you said we need confluence.
Yep.
What are we combining it with?
We combine it with traditional classical price action architecture. Specifically, we look for old resistance levels that have been broken.
Oh, the old ceilings.
Right. Traditional technical analysis dictates that when a significant price ceiling or resistance is broken to the upside, that exact same level should act as a floor support when the price pulls back down. It's a major psychological level.
So if the Euro-USD struggled to break above 1.100 for months, but finally smashed through it and rallied up to 1.120, classical theory says 1.1000 is now massive support.
Exactly. Now, here's the magic of the trend strategy. You look at your macro volume profile. If you see that one of those massive mid-trend high-volume nodes, an institutional pit stop, is sitting exactly perfectly aligned with that 1.1000 price action level, you have found the holy grail.
Oh, wow.
You have massive psychological confluence aligning perfectly with a heavy institutional volume footprint.
Not just a line on a chart anymore. It's a reinforced concrete bunker.
Right. You draw your line at the upper edge of that aligned volume cluster, wait for the year USD to pull back to the 1.1000 level, and you execute your long trade on the first touch.
Incredible.
The 71% win rate quoted in the sources is largely derived from exclusively trading these high confluence setups.
But I gotta push back on that 71% number. In the world of trading, anything over 60% sounds suspiciously high.
It does. It sounds too good to be true.
Right. If it's this accurate, what's the catch? Why isn't every retail trader retiring to a private island?
The catch is frequency and extreme discipline. A perfect trend confluence setup on a daily chart might only appear 3 or 4 times a year on a specific asset.
3 or 4 times a year, that's it.
That's it. Most retail traders do not have the psychological fortitude to stare at a chart for 3 months, waiting for a single perfect setup to align, and then wait another month for the pullback to hit their limit order.
Yeah, people get bored.
They get very bored. They start forcing trades in low-volume areas. They drop down to the 1-minute chart and get chopped to pieces by algorithmic noise. The 71% win rate is reserved for those who can execute the strategy with the cold, emotionless precision of a machine.
That makes a lot of sense. The edge isn't just the math. The edge is the patience to actually execute the math.
Absolutely.
And the sources also know that this applies across asset classes. We talked about Bitcoin and Forex, but this also works on indices.
Oh, heavily on indices.
Yeah, the sources specifically mention trading gap opens on the ENQ, the NASDAQ 100 futures. When the market gaps down violently at the open, leaving a massive blank space on the chart, where does it usually stop?
Exactly at a node.
Right. It stops exactly when it hits a historical high-volume node from weeks prior, and then it bounces to fill the gap. The mechanics of liquidity are universal.
They apply everywhere.
Okay, so we've built an incredible offensive playbook here. We know how to map the fortress. We know to enter at the outer perimeter to guarantee a fill. We have strategies for accumulation, rejection, and trend confluence. And we know we have to conquer our own boredom to wait for the first touch.
It's a full offensive suite.
But we have to face reality. Even with perfect confluence and the discipline of a monk, Trader Dale's absolute best win rate is 71%.
Which means you will lose.
Exactly. That means 29% of the time, almost 1 out of every 3 trades, the institutional fortress completely crumbles. The wall fails. So, transitioning from our offensive strategies, we need to talk about survival. Let's dig into risk management and the reversal pivot.
Risk management is the only thing that separates a professional trader from a gambler. You must know exactly where your thesis is proven wrong before you even enter the trade, and you must exit immediately without hesitation when it happens.
And this is where a lot of traders fail. They use arbitrary risk parameters. They say, I'll risk 2% of my account, or I'll use a 20-pip stop loss, regardless of what the chart actually looks like.
Yeah, completely random lines.
How does volume profile change the logic of stop loss placement? Where does it actually go?
The logic of volume profile stop loss placement is structurally beautiful. You place your stop loss squarely inside the low volume node, the LVN vacuum, that sits directly behind the heavy volume barrier you are trading.
Let's visualize this. Walk me through a trade.
Okay, let's say you're trading the S&P 500. You've identified a massive high volume node. The top edge of the shelf is at 50-50. The POC, the thickest part, is at 50-40. The bottom edge of the shelf is at 50-30.
Okay, writing this down mentally.
And below 50-30, the volume completely drops off into an LVN, a vacuum, all the way down to 5,000.
Okay, I have the picture. A thick zone from 50-50 down to 50-30, an empty space below it.
Right. You place your buy limit order at the top edge at 50-50. Your structural defense is that entire 20-point thick zone. You're betting that the institutions will defend between 50-50 and 50-30. Therefore, your stop loss must be placed outside the bottom of the fortress at, say, 50-28, inside the low volume node.
Oh wait, I have a massive problem with that.
What's that?
You explained earlier that LVNs are air pockets. You said price slips through them like a hot knife through butter because there's no liquidity.
I did say that.
If I place my stop loss at 50.28, right inside the air pocket, aren't it guaranteeing that I'll experience massive negative slippage? My stop might trigger at 50.28 because the market is falling so fast through the vacuum, I might not get filled until 50.20.
That is a phenomenal point, and it is the harsh reality of advanced trading. Yes, you risk slippage in an LVN, but you have to consider the alternative, which is the why behind the placement.
Okay, lay it on me.
Your entire trading premise was that the institution would defend the 50-50 to 50-30 zone. If the selling pressure is so overwhelmingly aggressive that it manages to chew through every single institutional buy order in that massive 20-point zone, defeats the smart money, and pushes the price into the vacuum at 50.28, the war is over.
The defenders have been annihilated.
Exactly. And because the price is now entering that LVN vacuum, the free fall will accelerate violently. It'll plunge to 5,000 in a matter of seconds. Yes, getting slipped on your stop loss at 50.28 hurts. But manually holding the position as it plummets to 5,000 because you refuse to place a stop in the vacuum will destroy your entire account.
That makes total sense.
You place the stop in the LVN because that is the exact coordinate where your thesis is mathematically invalidated, and you must cut the cord immediately, regardless of slippage.
That is a sobering but absolutely necessary way to view risk. The stop loss isn't a suggestion. It's the emergency eject button when the structural logic of the trade breaks.
Perfectly said.
Now, what about the inverse? How do we manage our winning trades? Where do we take profit?
The logic remains structural, but inverted. You take your profit before the price reaches the next opposing heavy volume zone.
So if I bought at 50-50 and the price is rallying beautifully up to 5100, but I look left on my chart and see a massive historical high-volume node sitting at 5120.
You do not get greedy and try to set your target exactly on the POC at 5120.
Don't push my luck.
Right. You know that 5120 zone is defended by an opposing army of sellers. They are going to start defending their perimeter at the outer edge, maybe at 5115. You want to front-run their defense? You take your profit and exit the market completely at 5110 or 5112, well before the price smacks into their brick wall and potentially violently reverses against your winning position.
Secure the bag before you hit the resistance. I love it. Now, we've talked about what happens when the wall holds, and we've talked about how to minimize the damage when the wall slowly crumbles and hits our stop loss.
The two standard outcomes.
But there is a third scenario detailed in the sources, and it leads to what might be the most brilliant bonus play in this entire deep dive, the reversal strategy.
Yes. This scenario addresses a very specific, often traumatic market event.
Dramatic is the right word.
What happens when the price doesn't slowly chew through the volume shelf? What happens when macroeconomic news hits, say, a surprise CPI inflation print and the price shoots straight past your meticulously planned high-volume node with absolutely zero reaction?
Like it wasn't even there.
It doesn't consolidate. It doesn't bounce. It just blasts through the entire zone in a single, massive 5-minute candle.
Speaking from personal experience, the immediate reaction is usually a cocktail of panic, anger, and feeling like the indicator completely lied to you. You feel cheated.
That emotional response is why most traders lose money. The professional volume profile trader does not panic. They realize that this specific type of failure is actually providing them with incredibly valuable, high-conviction information.
How is a catastrophic failure valuable information?
Because of what it implies about market sentiment. If a massive, multi-million-dollar institutional wall, a thick, high-volume node that took weeks to build, is utterly destroyed without even a moment of hesitation or a single bounce, it means there's been a fundamental seismic shift in the market.
Like an earthquake.
Exactly. One side of the market is completely, overwhelmingly dominating the other. The momentum is undeniable.
Okay, I follow the logic. But how do you practically trade that realization? My buy order just got blasted through. I just took a stop loss hit. I'm bleeding.
You have to possess the mental agility to immediately flip your bias. You leave your ego at the door. Let's say you were trying to short the market. You had a sell order sitting at the bottom edge of a volume shelf, expecting the price to rise up, hit the ceiling, and bounce down.
A standard setup.
Instead, a massive green candle blasts straight through the entire ceiling and keeps rocketing upward. You are stopped out for a loss.
It hurts, but I accept the loss. Now what?
Now you know the buyers are in absolute, undisputed control. They just smashed a major resistance level. So you deploy the reversal strategy. You wait. You know that broken resistance becomes new support.
Right.
The ceiling that completely failed to hold back the buyers will now act as a concrete floor. You wait for the price to exhaust its massive run and eventually pull back down to touch the top edge of that exact same volume zone.
The very zone that just failed me.
Yes. But this time, you are approaching it from the other side. When it touches that top edge, you execute a reversal trade in the direction of the new dominant momentum.
Oh, that's smart.
You are now joining the army that just won the war. It is statistically one of the highest probability setups you can trade because you have undeniable empirical proof of exactly which side possesses the overwhelming capital advantage.
That is just brilliant. You're using the failure of your initial structural setup as the ultimate confirmation for a secondary, even stronger structural setup. It just requires you to admit you were wrong the first time, take the small loss, and immediately switch from a bear to a bull.
And that, again, brings us full circle to trading psychology. The indicator provides the data, but the trader must provide the discipline to act on what the data is actually saying, not what they wish it was saying.
Wow, we have covered an immense amount of ground in this deep dive. Let's do a comprehensive big picture summary to pull all of these mechanics and strategies together into a cohesive framework.
It's essential to synthesize this information before attempting to apply it in a live market.
We started by tearing away the blindfold of pure, time-based candlestick charts. We introduced volume profile as the structural X-ray vision that maps volume strictly by price. We learned to identify the massive magnetic pole of the point of control and the thick, muddy defensive walls of the high-volume nodes where institutions park their capital. We examined the order flow mechanics of the low-volume nodes, the air pockets and vacuums where liquidity disappears. We discuss how to use these vacuums for capturing fast momentum breakouts, and crucially, how to safely hide our structural stop losses within them to ensure we only exit a trade when our underlying premise is completely invalidated. We tackled the crippling psychology of FOMO, emphasizing the absolute necessity of patience. We learned to never chase the initial breakout candle, but rather to wait calmly for the pullback, adhering strictly to the first touch principle to ensure we're trading alongside fresh institutional capital.
And perhaps the most immediately actionable realization for many traders. We learned to optimize our entries. We stopped trying to catch the exact center line of the POC and instead moved our limit orders to the outer defensive perimeter, the very edge of the volume shelves, massively increasing our fill rate and preventing the agony of missing a perfect setup by a few cents.
We tied all of this theory together with Trader Dale's battle-tested structural playbooks. Finding the hidden loading zones inside sideways, chop with the accumulation strategy, catching the explosive absorption of the rejection strategy, and hunting for the holy grail of confluence, where macro volume profile nodes perfectly align with historical price action support and resistance. Finally, we learned the mental agility required to execute the reversal pivot when sentiment shifts violently.
The overarching takeaway is that you now possess the conceptual framework to track the smart money. You can actually visualize their footprints, their accumulation zones, and their definitive lines in the sand. You now have the choice to trade alongside their massive capital, sheltering behind their walls, rather than blindly trading against them and serving as their exit liquidity.
But if we project this logic forward, it leaves us with a rather provocative, slightly unnerving thought to chew on.
I think I know where you're going with this, the evolution of the market ecosystem.
Exactly. 10 or 15 years ago, retail traders simply did not have access to this level of granular order flow data. It was locked behind expensive terminals. Today, any retail trader can boot up TradingView and overlay an anchored volume profile for free. The knowledge gap is closing. So if volume profile shows us exactly where the institutional defensive perimeters are, and millions of retail traders begin utilizing this quote-unquote insider knowledge to place their entry orders at the edges of these volume shelves and hide their stop losses in the exact same LVN air pockets, how are the institutional algorithms going to adapt?
The market is a relentless apex predator, and it constantly evolves to hunt the largest pools of available liquidity. If the retail herd moves from trading random moving averages to clustering their orders around volume profile edges, the algorithms will undoubtedly adjust their hunting patterns.
Will we start seeing institutions intentionally orchestrating massive fakeouts? Will they deliberately push the price just past the edge of the volume shelf, deep enough into the LVN to trigger the massive cluster of retail stop losses, absorbing all that forced selling to fill their own massive orders at an even better price, before instantly reversing the market back in the original direction?
What you're describing is a structural shakeout, and it is highly likely that as volume profile becomes more mainstream, these stop hunting algorithms will become hyper-tuned to attack the exact LVN zones we discussed today. The game of cat and mouse never ends. The battlefield just shifts to a new dimension.
It's a terrifying and fascinating puzzle to mull over. The indicator gives you an edge today, but you have to remain constantly vigilant to how the market reacts to that edge tomorrow. And that brings us directly to you, sitting at your desk. We want to know how this deep dive intersects with your actual trading reality. Do you currently have volume profile active on your charts? If so, how has seeing these high volume nodes changed your ability to identify hidden support and resistance compared to just drawing trend lines? Have you successfully executed the patience required to catch a perfect first touch pullback, or are you still fighting the psychological demon of FOMO on the breakouts?
The most profound exercise you can do today is simply to open your charting software, apply the fixed range volume profile to a recent massive market move, and objectively look at where the price historically paused, turned, or accelerated. The alignment of the historical data will likely shock you.
Absolutely. Go pull up a chart of Bitcoin or gold or the S&P, apply the X-ray, and see the structural matrix for yourself. Keep refining your edge, stay incredibly patient, force yourself to wait for the pullback, and always let the market come to your structural levels. Stop chasing ghosts. Thank you for joining us on this extensive deep dive into the hidden architecture and institutional psychology of the financial markets.
Until next time, keep questioning the mechanics behind every single candle you see on the screen.
And remember, if you can't see the volume, you are fighting the battle completely blind. Stay sharp out there and protect your capital.